And the most important thing that we look for is track record. Simple, right? So we want to make sure that the sponsor has plenty of full cycle deals to show that they can actually get the job done.
Welcome to The Path to Wealth, the show about well-being, fulfillment, and financial freedom. I'm your host, Hennche. Welcome back to The Path to Wealth. I'm your host, Hennche. Today, our guest is Elijah Brown, a U.S. Army Reserve captain and the founder of GoldHawk Capital. Elijah has successfully acquired over 2,500 multifamily units across the country. In this episode, we will hear how Elijah got into real estate, his strategies for raising capital, and the common challenges he faced as a real estate operator. Welcome to the show.
Thanks so much for having me on. I appreciate it.
So tell me a little bit more about where did your money mindset start? Why real estate and why you're keen on investing?
At a really young age, actually. So my best friend had an accountant for a father. He was very insistent on both of us reading the Rich Dad, Poor Dad book and teaching us everything he could about money. And so from a very young age, we were scheming ways to set up businesses. I think our first idea was doing a strawberry daiquiri cart in the middle of town. And then we had a few other ideas, and none of them really took off until I got to college, and we both started doing this real estate.
That's a really early start, and it's so nice to have that guidance early on.
Yeah, definitely. He's definitely a very eccentric man, but definitely thankful for the advice that he provided. And we also learned a lot of lessons on what not to do from his various business ventures. So that was helpful as well.
Yeah, sometimes not what to do list is actually, at least for me, it's always been like deriving from what not to do or what I don't want leads me towards what works eventually. And like, okay, got this one out, and ideally you want to learn from other people's failures before you start making your own.
Definitely. I mean, that's the whole point behind education. Like if you're reading the books, taking a course or doing mentorship or really anything like that, the point is to try to get ahead and not make all those mistakes that people made in the past. So couldn't agree more. It's super important part of growing your business and doing well.
So, and what was your journey like in real estate? How did you start out? What was your first deal like?
Well, I didn't know that I wanted to get into real estate until halfway through college. At first, I thought I was going to be an investment banker or a hedge fund manager or something like that. So I was going down a recruitment pipeline while I was at school. And after doing an internship at a hedge fund and at a bank, I realized I really didn't want to do that because it was not much fun. It was high stress, long hours. And actually, I found real estate through YouTube videos. There's a few channels that come to mind. So Phil Pustajovsky, it's a tongue twister. Chris Crone, Graham Stephan, Bigger Pockets, Meet Kevin, a few of the earlier real estate YouTubers. I watched like all of their videos, hours and hours and hours of videos. Watched videos for 2 weeks straight in my college dorm room, and then made the decision that I was going to go buy my first rental property. And that was what started it all. I had no money and no credit and no strategy and nothing. I actually found a consulting firm that was trying to pitch newbies on holding their hand through their first real estate deal in exchange for $5,000. And I signed up with them. You pay them at closing. And I had to raise money because I didn't have any money and I wasn't able to get the loan by myself. So I gave my best friend, the same one from our your last question. And I called my cousin as well. And we both pooled together our life savings and applied for the loan. And we ended up buying a single family house in Orlando, Florida. That was the first one.
Nice. Do you still have that house or you sold it already?
We sold that one. So we did 4 single family to begin with, and we ended up selling 3 out of 4. So we've got 1 left. It's cash flowing. It's not the best time right now to sell. By that, I mean, it's May of 2024, and we're going to wait until the market comes back a bit. But meanwhile, the property's cash flowing really well. So there's no need to sell it.
Yeah. And now fast forward to now, you're actually raising capital for fund-to-fund structures and really trying to optimize also for having that leverage as a group, getting a better cut of the deal by having a bigger negotiating power coming in with fund-to-funds. Maybe you can speak a little bit more towards that model and what that means.
Sure. So I started off on the operations side. By that, I mean, I was the one going out, finding the property, working with the bank for a loan, sourcing investors, underwriting, due diligence, asset management, refinancing, construction, the whole 9 yards. I was doing all of that. And I did that for about 7 years. I'm still doing it on a few properties. And it was like a burnout, just not fun, lots of headaches. And I decided that I just wanted to focus on what I was best at and what I could make the most money at for the amount of time that I spend. And for me, that's raising capital and due diligence. And so a lot of my earlier deals, 12 of them, went full cycle. We sold the properties, made some money. And I decided I just wanted to be more of a passive investor, but I was also good at raising money and due diligence. And so instead of just being like a passive investor and writing $25,000 or $50,000 checks every once in a while for deals, I realized, well, I could raise money and write a larger check for these deals. Instead of investing $25,000 or $50,000, we'll invest $1 million or $2 million or $3 million, and then we'll be able to negotiate better terms in that deal. Essentially, coming in with a much larger check size and getting a better profit split, for example. Yeah. And so that's the business model now. On one hand, we're doing a lot of work to source really solid deals with top tier operators. And on the other hand, we're also making relationships with investors, we call our limited partners, to help us fund those deals. So right now we're doing both. It's due diligence and then also capital raising.
Yeah. And that's often also the question, like an LP still needs a lot of understanding to make sense of due diligence. Like if someone is seeing their first couple deals, it's good to have a strong partner who is like, hey, what I'm really focusing on is making sure nothing goes south here or you're not missing anything. And that's the core component of due diligence that you're taking.
Yeah, 100%. I mean, it's I've spent 20,000 hours doing real estate and learning how to analyze deals and know if a deal is good or bad. And most people don't have time for that. They have their job, they're retired, they're doing other stuff, and their full-time job is not to conduct due diligence. So I do that job. I sort through hundreds and hundreds of deals every year, and I weed them down based on some higher level criteria. And then when I've got the list of deals that I want to pursue, then I do a very deep dive due diligence. I use a checklist. I do all kinds of meetings with that operator, asking questions, figuring out what's going on with the deal. And then essentially, I will present that due diligence to my investors, and they can make a decision if they want to invest or not.
So what are some of the key objectives that you're looking for, or what are the qualities of an operator that you would even consider?
So 90% of the game is just selecting a competent operator. The numbers come second. So if we find a good operator, we also call them sponsors or general partners. If we find a good one, we'll do a lot of deals over and over again with them. But getting to that point where we have enough trust with the operator to even invest the first check, it takes a lot of work. And the most important thing that we look for is track record. Simple, right? So we want to make sure that the sponsor has plenty of full cycle deals to show that they can actually get the job done. We're going to invest millions of dollars with them. We want to make sure they're not going to screw up and lose our money. And so the best way to know if they're going to be successful is if they've done it 100 times before. Obviously, 100 is a large number. Yeah. We start at like a minimum of 5 full cycle deals before we'll get involved. But the deals we're raising capital for right now, some of these sponsors have done 100 deals. They have 80 or 90 full cycle. And so the bar is high for us because we're writing large checks, and we are only willing to take risk with the top 1% of opportunities that we see.
Yeah. And that's how mitigation works. It's also if people think about, okay, who's the most successful capital allocator? And then they think of Warren Buffett. And that's why Berkshire Hathaway has a certain size, because there's trust. Yeah, there's a track record that's undeniable. I mean, now they might be a little bit more in question given the age and longer past, but for the longest time, it's just a sure bet. And that's kind of where trust, longevity, and consistency really plays out.
That's so true. It's funny, even now, after I've done 25 deals and a 12 full cycle, most of the time the investors they're investing because they trust me, but they're also digging deep into the deal. If I were to just come to them and say, trust me, I don't have a deal yet, the chance of them investing is still pretty low. So the difference there is that at some point, the track record is big enough where it doesn't matter what the deal is. You're a competent operator, and someone's going to invest capital into what you're doing because of your track record. So I see 60, 70-year-old guys out there with a massive track record, but no business plan, no strategy, nothing at all. And they just call up a family office and get a $50 million commitment on the phone. No opportunity identified. That's like the goal to get there. And so like all the deals that I'm doing now, the point is for establishing track record. It's like I'm working toward a situation in 20 years from now where I can just make a phone call and raise $1 billion or whatever. But it takes a lot of work and a lot of building track record to get to that point.
Yeah. And again, it's just because I love Warren Buffett. He calls it operating at the speed of trust. You can make a phone call, and without getting too much into the details, you know that the other party will do right to you. And you can only do that by building very consistent results and having that track record. And I think this is the power of consistency. And it's probably where goodwill compounds faster than your money if you do it right.
Yeah, absolutely. That's very true. Even like to the point where you could have deals that lose money. You could have failed deals that went south. You could have a bunch of deals that went south. But if you've done a lot of them and your investors trust you and you're transparent and they like you, then they'll invest again. You'll keep getting that money. So a lot of people freak out when they have a deal that goes bad, but they don't realize that the number one thing is to maintain that trust and transparency with the investors. I see a lot of sponsors, they go quiet when their deals start going south, and that pisses off the investors, and then they never get investment again because they didn't handle it right.
Yeah, I think this is definitely how we also decided to not pursue certain sponsors that we've partnered with in the past when communication isn't there. Like, it's like, even if there are challenges, how do you handle those challenges? How do you choose to communicate during those challenges?
Right.
Like if there is a macro environment that's unprecedented, like for example, rate hikes, then that can be communicated. And yes, maybe not every LP will understand or will be like, but even more experienced LPs will also understand that occasionally something might go off plan.
Yeah, absolutely. That's exactly right. And so it's the sponsor's job to really mitigate as much risk as they possibly can. But at some point, it can be out of their control with market events. And so it's really important to just maintain the communication channels because those people might invest again.
So given the check size and given that you kind of pursue a different position in the overall deal structure, do you also have additional influence to maybe mitigate things when they go south? Do you have any other way to get involved with them other than like, hey, if you ever want to see a check from us again, you better get this straight now?
It really depends on the deal and the sponsor. So if we're talking about like a smaller deal where GoldHawk is going to bring a significant portion of the capital, we will get rights that allow us to participate in decision making.
Mm-hmm.
Essentially, we have more leverage over the deal because we're bringing more of the money. But in deals where our check size represents a very small percentage, like less than 10%, then we really don't get those types of rights that like a JV partner would get. We do get special terms. So like our returns are higher, but to really have a say in the operations and management, you need to bring a significant portion of the capital into the deal. And that's just how it works. Now we do maintain a very strong communication channel with those sponsors. So limited partners, regular investors, they'll have to email an investor relations person and wait a couple days or a week to get a response, if they get a response at all. Whereas, we will just pick up the phone and call the sponsor or text them or, email them and get a response immediately. So that's kind of another one of the benefits, being the administrator of that large check, we hold more leverage over the deal. So they are more willing to respond when we have questions.
Yeah. And then in terms of the structure, maybe you can speak a little bit to, so fund of funds speaks to the fund itself is its own entity that then goes and as an entity invests in another entity, right?
Yeah. There's two ways to raise capital for a private placement deal. The first way is by joining the actual deal LLC as a manager, and you're part of the management team. You are one of the sponsors, one of the operators, and you're raising money directly into that deal. Now, you still have to be an active material participant in ways other than just capital raising. Otherwise, you're violating broker-dealer laws, essentially dealing without a license, unless you have a license. The other way to raise capital is by setting up your own vehicle, your own completely separate entity, LLC, raising money within that LLC, and then using that money to write one check from the LLC to the deal. And because I'm an active material participant, I'm the manager of my own entity, I am qualified to take fees in exchange for raising money. Mm-hmm. Like that is acceptable.
At what stage does the fund of funds structure actually make sense? Like I assume there is structural fees like setting up the entity and then annual fees like operating it or reporting. At what stage does it stop making sense?
It depends on the fees that are involved in the deal. Sometimes it makes sense to do your own entity at all times because you'll be able to make more money that way. But other times it makes more sense to just join the general partnership, the actual deal LLC, because you make more money doing that. I prefer to do things at more of an arm's length, but also we're not at the point where we're bringing 90% of the capital. When you can bring a significant portion of the capital to the deal and you have so much leverage over the deal, you go into the GP, you go directly into the deal. You don't need a private vehicle because you can negotiate as much compensation as you need from the actual deal as a manager of the deal. Whereas if you're bringing like less than 25% of the capital into a deal, you have less leverage. The best you can hope for is to negotiate superior preferred terms for your investment.
Yeah. And how do you structure it then? Out of those preferred terms, is that the spread you're taking for yourself?
So it's different for every single deal.
Okay.
By preferred terms, what I mean is we're going to do a combination or one or the other or all of the above of reducing the acquisition fee that the sponsor's charging to us, reducing their portion of the profit split, increasing our preferred return, so the amount of money we have to make before the sponsor starts getting profit split, and then additional like legal terms like voting rights and stuff when you get to that point. And then obviously because the fees are going to be lower for our check, there's more profit in it for our vehicle. And that's where we're able to take some of that for ourselves as the managers to pay ourselves a fee. And so the way that we typically structure it is that our investors in our deals, our limited partners, our fund of funds investors, they are typically getting roughly, after we charge our fees, they're getting roughly the same returns that a regular investor would get who's going direct into the deal. However, the kicker here is that if the deal outperforms, it does better than the projections, then our investors do far better because we are usually removing the sponsor's profit split on overperformance. Mm-hmm. So typically the sponsor will take like a larger portion of the profits when the deal does really well. But because we're negotiating a lower profit split, and especially a lower profit split when the deal outperforms, our investors get to keep more of that profit.
And I would assume a lot of this has to do with your relationship with the sponsor, as well as also maybe their track record. Like somebody who's had literally 100 deals and 85 plus exits, probably a lot less likely to give in on those terms, unless maybe he really needs to fund this particular deal right now and you are able to write the check.
Yep. So we're solving a huge problem for operators. I refer to it, we're like a really small capital markets advisory firm where they have an issue. They can't raise all that money quickly or efficiently. If they could just send an email out and have it raised in an hour, they wouldn't need us.
Yep.
It's a lot harder to raise money, and that's why we're paid a lot. So these sponsors will come to us and they'll say, can you take out 10, 20, 30% of our capital raise with one check? And we'll say, absolutely, we can do that. Here are our terms. Because now the sponsor doesn't have to go raise capital and jump on the phones and be worried and all kinds of things involved with the capital raise. They can just come to us, get a check, and move on to the next deal.
Mm. And then see if that's your core quality is operations. And by giving up a couple basis points there to someone who's bringing the capital, you can solve for that headache literally with one phone call in that end, because they call you, they're like, hey, we've done this before, let's do it again.
Yeah, absolutely. Like, for example, let's say the sponsor, the operator, is charging 2% acquisition fee on the purchase price. I'll go to them and be like, I'll give you $1 million, but for us, we want a 1% acquisition fee, or give us a rebate. And then they get a huge check. Instead of they have to go to 20 people at $50,000, or they could just come to us, get one check, and cut us a deal on the fee.
Yep. What are your favorite fees to work on? You already said the kicker earlier. You want to make sure that you're participating in the upside.
So are you asking like what fees we're usually asking from the sponsors, or what?
Yeah, where do you see the biggest potential for you, the team and the LPs, like to make a dent there? So reducing the acquisition fees, one you mentioned. The other one is making sure the upside isn't capped.
Yeah. The profit split is the biggest one. We want to make sure that we are controlling as much of the upside as possible. We are optimistic about multifamily and what we're investing in. We're only investing in the top 1% of stuff that we look at. We have high conviction in what we're investing in, so we want to capture the upside. And so let's say a sponsor's asking like a 70-30 profit split where they get 30% of the profits and we get 70. Maybe I'll come to them and be like, hey, this is going to be an 80-20 because we're writing a large check. You're going to get 20% and we'll get 80%. And a lot of times sponsors, once the deal hits a certain return rate, they'll increase their percentage of the profit. It's like another tier of that waterfall. So they'll go from a 70-30 to a 50-50. Part of my negotiation will be we're removing that second tier. There is no 50-50. It's just an 80-20 flat split and no additional tiers. So when the deal does outperform, all of the regular investors that went to the sponsor to invest, they're getting hosed because the sponsor's taking a huge portion of that profit, half of it. Whereas we're still getting 80%.
Yeah. Which could be extremely substantial depending on how the overall projections. Yeah. So one of the things you also appreciate is travel, right? So this is really something that enables you to stay on the road, travel. Where have you been lately, or where are you planning to go?
Sure. We lived in a van for a year. We did a lot of national parks in the US, and then we also spent 3 months in Mexico. We did the whole Baja Peninsula, and then we spent a month in Spain and Portugal last year. And in November, we're actually heading to Thailand for 6 months.
Oh, wow. How are you able to keep the work mindset on while you're on the road? That's usually one of the biggest challenges that I face. I try to keep up with everything and even like time zone challenges. But like if I'm sitting on the other side of the planet, it's a lot harder to visualize myself into a property in Texas,
It's good. It forces you to put systems and processes and personnel in place to handle those issues. And also forces you to enjoy your life a little bit as well. So I work extremely hard when I have an office and time to just focus on work in the business. But when we go into travel, obviously we're only able to work like part-time. And so I need to rely on my team and our automations and all of the things that we set up to keep the business running while we're traveling.
Yeah, it's intelligent. So build systems and have other stakeholders, team members in place that make sure that everything stays monitored. And And I'm sure you're always just a phone call away, even if you're on the road.
And I'm always working too. So
Yeah.
there's never a day off when you're the boss. I'm always checking my email, always jumping on a call or two, always drafting some kind of update or new deal alerts. So the work never stops. It's constant, but traveling forces me to be more efficient with what I choose to do. It really makes you prioritize.
Yeah. Because after the time, I think especially if you keep being on the road, like then the logistics itself consumes so much energy every day.
It does. Yeah.
Yeah.
It really does. And so what we tried to do was just really doing our traveling, like the movement during the weekends, and trying to be planted in one location during the week. What I think makes what makes more sense for an entrepreneur is going and doing like a few months at a time, like at an Airbnb or at an apartment or something. You don't need to be traveling every 4 or 5 days.
Yeah.
That's exhausting. Like go and become involved in the actual community where you are, get to know the location more, stay there for like a month or 2 or 3, and really get to know, like, we're going to Thailand and we're going to be in Thailand for 6 months. We might take, a 1 or 2 week trip elsewhere, but we're not doing a ton of moving around.
And I think that's where efficiency meets exploration. You get to, as you said, you become part of the community. You get to know this part of the world very differently. Even culturally, it translates more the more time you spend there. And it's financially efficient. And also for you, the way you're settling in, it allows you to have a routine that allows you to work.
Yeah, absolutely. It's really, really about quality of life. Like, what's the point of doing all the work and building these $1 million empires if we're not going to go and enjoy and explore? And so it's important to make time for that.
So what are your goals for the next couple of years? You already mentioned 20 years from now, you want to make the phone call to raise $1 million or $1 billion. You said $1 billion. What other goals do you have for the next couple of years?
So at least for the business, what we're doing right now is working. And so we're going to continue focusing on doing that and pouring more gasoline on that, focusing on what we're doing that's working and doing that for the next 2 to 3 years. I'm working on that track record. And within the next year or so, I really want to start that first blind discretionary fund. And so I'll be looking for essentially a family office to help anchor that fund with a co-GP investment of roughly 10% of the raise, which I'm going to start with a $100 million raise. So the first investment will be about $10 million. And so I'm going to keep doing exactly what I'm doing now on the deal side. That money is just going to be used to write more checks, larger checks, and do exactly what I'm doing now with sourcing fantastic deals and then negotiating better terms in them. And so it's just a little bit of a difference in how that capital is raised and deployed.
So if somebody is already at the family office scale, what incentive do they have to write you a single $10 million check? So that could be potential diversification for them. They are participating.
Oh, for sure. It gets them access to a fund manager, a jockey, me, who's going to do a ton of hard work to bring them deals. Essentially, I'm the deal flow guy.
Yeah.
And by writing a $10 million check and coming in as a co-GP, they're going to have rights over me, just like we have rights over the deal when we write large checks. And so, they'll be able to approve certain things and have checkbook control and certain rights because they're the ones putting up the capital. So it's great for them if they trust me.
Mm-hmm. It all boils down to trust, consistency, and track record. But I mean, you've already well on your way on there.
I'm working on it.
Mm-hmm. So one of my favorite questions, what do you consider a life well lived?
Having a good time. You just got to have a really good time. And when you're like old and on your deathbed, what are you going to remember? I just want to remember that I had a really good time. That's really it. I want to be grateful for the life that I lived. I think that's actually like a daily practice. A lot of people are so obsessed with the concept of like being happy and like working really hard towards something, but they don't realize that like the life they're actually living right now is incredible, and they need to appreciate that when they do, they'll have much more fulfilling days. So that's a goal of mine that I'm trying to work on. And it's really like about having really great experiences with people that you want to spend time with, and then appreciating those and feeling grateful for those.
Yeah. And interesting enough, once you start being grateful on a daily basis, it turns out that you have a lot more joyful days because you're grateful. And it just kind of becomes a self-fulfilling prophecy from there on.
Yeah, absolutely. Got this journal right here. So like every morning I write a bunch of stuff that like memories from yesterday, things I'm grateful for, all kinds of stuff, goals. Just because if I don't, I don't even know what I had for breakfast this morning. I don't know what I did yesterday. So that kind of puts things in perspective and helps me remember and appreciate what I did yesterday and today and what I'm going to do tomorrow.
My sister has a really interesting one. She has a 5-year journal. So on each page you have 5. And then, so eventually in year 2 on the same day, you will see what you've done the year before. And year 5, you'll see what, I think that's a very interesting thought exercise.
Sure.
Yeah. Well, Elijah, thank you so much for making the time. Where can people connect with you and find out more about the deals? I saw you just actually raising one. It's a 5 or 6C, so we can put it out there. GoldHawk Capital.
Yeah, it's an awesome deal. The operator has done 100 deals. They've got almost 100 full cycle deals too, which is great. It's in a really high quality neighborhood in Florida. They're buying it at an awesome purchase price, and the assumable debt is at a low rate, and it's going to cash flow really well. It's just one of those really low risk, low execution risk, high cash flow, great basis type of deals. We hosted a pitch competition on LinkedIn, and this was the best submission out of about 35, and it meets all my criteria. By the way, if your listeners are interested, we have a bunch of free resources for aspiring investors or real estate investors, limited partners. One of those is a guide on the top 7 things that I look for in deals, and they can download that at goldhawk.us/ebook. Oh, there you go. You got it pulled up. And then, so that's one. And then we also have our due diligence checklist that we prepare for every single deal. It's the deal inspection one. It's just goldhawk.us/inspection. And then if you're feeling like you want to try doing some Excel calculations, you can get more involved in the deal analysis by checking out our LP calculator. And that's goldhawk.us/LP calculator. And then the last one I'll mention is list of red flags. So every time you're looking at a deal, go through this real estate deal, go through this list and see how many red flags there are in the deal. Because if there are a lot of them, maybe you shouldn't invest in the deal. And that's just goldhawk.us/71 red flags.
Yeah, especially those big waving red flags. We just got to take them for what they are when they're there.
I got to stop telling people all of the resources, because then they're going to get decision fatigue. You need to just pitch one and then and then that's it.
Yeah.
It's like my deal emails. I'll have 6 links. It's here's the pitch deck, the due diligence, the Zillow or whatever, the underwriting model. I need to stop doing that and just be here's one link. It's the portal where you can sign up.
I just saw a study on decision fatigue last week. What they did is they went to a farm stand and they were either selling 3 jams or 26. And the sales were dramatically different when they were selling 26. They were selling so much more stuff when they just had 3.
Wow.
Because people just couldn't I don't know, should I get strawberry blueberry? Should I just get blueberry, or should I get blueberry citrus? Or...
Oh, that's great. By the way, for anyone interested in raising money or growing a business, figure out what you can provide people that is of tremendous value to them that they would pay for, and then give it to them for free in exchange for an email address. And then you'll grow your lead list really, really fast that way.
That's basically what you're doing with the resources.
That's my lead generation strategy. That's how I find investors for my deals.
Yeah, nice. Awesome. Thank you so much for sharing.
Sure.
Thank you for joining us at The Path to Wealth. We hope you enjoyed today's episode. Check out our upcoming guests and be sure to share it with all your friends and family that want to take their life to the next level of wealth.